The stock market continues to remain highly volatile. Nowadays, a movement of less than 1% in the index feels like a normal day. This is because we have been seeing frequent movements of 3 to 5% in recent weeks. Volatility is expected to remain in the near term. The VIX, also known as the volatility index, is still at elevated levels. Trade tensions, especially due to tariffs, are a key factor in this environment. These tensions are not likely to be resolved in the short to medium term. Before we begin, please note this video is for informational purpose only. I am not a financial advisor. Please do your own research or consult a qualified professional before making any investment decisions. In this video, let's look at 4 dividend paying companies. These companies have a track record of generating consistent free cash flow. They also return a portion of that to shareholders in the form of dividends. Stock number 1, Energy Transfer. Stock ticker symbol ET. This company operates in the energy infrastructure sector. They primarily deal with pipelines and storage facilities for natural gas and oil. They sign long-term contracts which includes fixed fees. This provides more predictable income. Despite this structure, the company's stocks has still experienced recent volatility. The market cap of Energy Transfer is around $58 billion. In the past 12 months, the stock has gone up by 10%, but in the current year, it is down nearly 15%. One key factor here is the ongoing trade tension between the United States and China. These tensions may affect energy exports, including liquefied natural gas. From a financial perspective, Energy Transfer reported the following numbers. In 2020, the company's EBITDA was $6.44 billion. By 2024, that numbers increased to $15.4 billion. Their free cash flow in 2020 was $2.2 billion. In 2024, it rose to $7.5 billion. The dividend payments total $4.6 billion. This gives the company a free cash flow payout ratio of 61%. The stock is currently trading at an EV to EBITDA ratio of 8.5 times. This is considered a relatively low valuation. The dividend yield is close to 8%. Stock number 2, Regeneron Pharmaceuticals. Stock ticker symbol RAGN. This company operates in the healthcare sector. They are known for drugs that treat eye-related conditions and inflammatory diseases such as asthma. Regeneron has a market cap of approximately $62 billion. Over the last 12 months, the stock declined by 36%. Year to date, it is down by 20%. In the previous year, the company reported revenue of $14.2 billion. This reflects an 8% year-over-year growth. Future revenue growth is projected to be 2% in 2025, 7% in 2026 and 9% in 2027. The company generated free cash flow per share of $28.83. It currently pays a dividend of $3.52 per share. This means the dividend is well covered by free cash flow. The dividend yield is below 1%. However, the company has room to increase dividends in the future if earning and cash flow remain stable. Stock number 3, S&P Global. Stock ticker symbol SPGI. This company is part of financial services sector. It is well known for providing credit ratings, financial data and analytics. S&P Global has a market capitalization of $148 billion. Over the past 12 months, its stock rose by 15%. However, it is down by 5% year to date. In 2024, the company reported revenue of $14.2 billion. In 2025, revenue is expected to reach $15 billion. By 2026, it is projected to rise to $16.1 billion. The company's EBITDA increased from $3.6 billion in 2020 to $6.8 billion in 2024. It maintains a high EBITDA margin of 47.7%. Free cash flow also grew from $3.2 billion in 2020 to more than $5 billion in 2024. This represents a free cash flow margin close to 40%. While the dividend yield is below 1%, S&P Global has increased its dividend for over 50 consecutive years. It has a 5-year dividend growth rate of 10%. Stock number 4, NextEra Energy. Stock ticker symbol is NEE. This is the largest utility company in the United States based in Florida. It operates in both the US and Canada. NextEra focuses on renewable energy, especially solar and nuclear energy. The company has a market capitalization of $139 billion. In the last 12 months, its stock increased by 8%. Year to date, it is down by 5%. The dividend yield is 3.4%. NextEra has increased its dividend for nearly 30 consecutive years. The 5-year dividend growth rate is 10.44%. In 2024, the company reported revenue of $24.7 billion, which was a decline due to the discontinuation of a loss-making natural gas transportation service. Earnings per share are expected to be $3.67 in 2025. This gives a forward PE ratio of 18 times, which is lower than the company's 5 years average of 24 times. It also trades at an EV to EBITDA ratio of 16.2 times compared to its 5 years average of 19.3 times. This shows a more attractive valuation. So, we have now seen 4 dividend paying companies from 4 different sectors: energy, healthcare, finance and utilities. Each company offers either a strong dividend yield or consistent dividend growth. These companies may help bring stability and steady cash flow to diversified portfolio. Due to current market conditions, investors may consider accumulating high quality stocks gradually and not all at once. Future events such as trade negotiation, inflation or interest rate changes can impact the market. Review each company's fundamentals before making investment decisions.